In sooth, I know not why I am so sad. All right. Hey, good morning, everybody. I have found my inner motivation. How are you doing? It is what day of the week is it? Honestly, it's weird. Huh? Wednesday. We must have Fed meeting minutes coming up this afternoon. We must have oil inventories a little bit later. Oh, and don't we have another dumb prediction for non-farm payrolls? My goodness. We have some yen strength. We have some pound weakness. Well, I guess pound comeback a little bit. I don't know. But it's all good in the hood. It's better than yesterday. That's all that matters, right? Yeah. So, yeah, I hope you see the charts all right. Well, without further ado, let's play the happy music and get going. Life is beautiful. Yeah. Where's my mouse? Guess I need a mouse. All right. Well, welcome to Forex.Today and another Forex trading strategy session. Let me first remind you that trading Forex is risky, not appropriate for everyone. Your past performance, however, good or bad, isn't necessarily indicative of future results, but it's always wise to be small, to be humble, to focus on the long term, and never risk money you cannot afford to lose. So, ni hao ma! My name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay. Jumbo! We do these sessions 7:30 in the morning, which is approximately London lunch, Monday through Thursday here at Forex.Today, where you also get to share your own trading ideas and get feedback from fellow Forex traders like you. Every Friday I'm at fxstreet.com. Those are premium webinars, premium member webinars. I'm also Forex Speaker of the Year over at FX Street. So nice to have you here today. I think we've got a lot of stuff to talk about, don't we? It's going to be a busy day. So let me look around the world and see what catches my eye. How about the 10-year T-note? Holy smokes. 1.37. 1.3. I mean, what is that? Is that like an all-time low for the United States? Yeah, that is so ridiculously low. It's just really amazing. Zelda, I used to have this theory that the 10-year T-note could not go past 2.0. I looked at things sort of Newtonian-wise and just thought, well, if we dip below 2% on the 10-year T-note, then the whole yield curve would have to shift, and interest rates would have to go negative, and we know that's impossible. Yeah. Oh wait, the whole world's changed. Yeah, you can have negative interest rates now, but there was a time when you're like, that was impossible. But anyways, just amazing. Oh, what's a T-note? T-note, treasury note. So if you lend the United States of America money, they will pay you 1.37 back. Yeah. T-note, treasury note. So anyways, that is really, 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 really ridiculous. So I don't know, is it time to refi? So interest rates now are lower than probably the worst part of the crisis, except now people have money and credit. So anyways, that's just amazing. Oil has come down, breached below 46 on the cash anyways. But yeah, down. And I think that's what we had this doing, right? Have we been saying rig count up, oil prices down? So we got inventories. They should come out. And usually this is a period of drawdown, which would push prices up. So, we got to be careful here. Hopefully it doesn't mix things up too bad. But let's look around the world. The S&P 500 futures are down more than 0.5%. But how are they doing in Europe? Since the S&P 500 isn't technically open yet, how are the Europeans doing? Well, the Germans are down 2%. The British are down 1.5%. Wow. The Chinese down 1.25. Hang Seng is down 1.25. French, well, yeah, they're down over 2%. Wow. Wow. That's a bad day, everybody. How are those European bank stocks doing? Setting up for a bounce or a buy or something, right? Telling you, there's blood in the street. Doesn't mean you be foolhardish, but it doesn't mean you turn a blind eye either. There's probably some buying opportunity somewhere. If not now, then soon, right? Miles says lack of cash for you bank. Sure. But what I'm saying is, are you thinking 25 years from now? Do you think Italy and Spain and France and Germany, do you think they'll have banks in 25 years? Right? Some of them will fail. Well, we don't know. It's Europe. You're not allowed to fail. It's the giant, group hug experiment, and everyone's choking. So that's the thing. Can Italy put $40 billion into their banks? And right now, that's illegal, according to Italian law. But whatever. They'll figure it out. They'll bail them out. Don't worry about it. Got no money, you got no car, you got no woman, and there you are. And then the government will bail you out. All right. So, anyways, that's very interesting. Yeah, these rates are just crazy. And the other, of course, the crazy part is if 1.37 seems low to me, it's ridiculously high compared to the rest of the world. The Swedish central bank left interest rates unchanged, but when you look at like Sweden and Norway and Denmark, the Scandinavian currencies, I don't know if you trade them, maybe you do, maybe you don't, but they have to deal with this European situation. No, they don't have a euro, but they're still tied in with those, with the European economy, and being trading partners with them and such makes things complicated. But imagine you're Portugal as well, like talking about the ECB, right? Um, does Portugal face the same economic conditions as Germany? And is it possible one country would want a strong euro and the other country would want a weak euro? And like, how do you reconcile that, right? Well, the thing is, Miles, Germany is one of the largest exporting economies in the world. So one time I was in Connecticut at a racing event for vintage cars. It was the Rolex Vintage Racing Series or something like that. And we were out there in a Lotus, and you know they had all these other beautiful cars like old Bugattis and old Porsches and Ferraris, and just great. So I'm up on the hill, and I strike up a conversation with the guy, and he's the head of sales for, or the CEO of BMW USA or something like that. And at that time, the euro was like 140 or 150. I can't remember. It was when it was super strong. And he's like, yeah, we used to sponsor this event. He's like, we don't do it anymore because we don't make money in the United States selling our cars, because they would sell them for US dollars and then convert them to euros, but the euro was unbelievably strong. So there wasn't even a point of like selling cars. Like, what's the point? Because by the time you factor in exchange rate differentials, there was no point. So I don't think Germany would want a ripper strong euro in that situation. So there I am sitting with him, and he's like, yeah, we don't want to sell cars. Isn't it amazing? Like, you're sitting there with the senior executive of a major car company in the United States, and he's like, yeah, we don't even want to sell more cars. There's no point. We used to advertise here, but why sell a BMW? It's just a waste of time. I'm like, sir, isn't that your job? Yeah, well, whatever. Polish zloty had interest rates stay the same. Go Poland. And then, okay, so the rest really is teed up today. So at 8:15, we have another dumb prediction. At 10:30, there's oil inventories. And at what, 2 is the Fed meeting minutes. The thing is, I would imagine the Fed really didn't think Brexit would go through. So I think their language and their discussions would be with the assumption that there wouldn't be a Brexit, and that they would just move on, and that's out of the way, and and they'll start raising interest rates. Well, if that's what happens, I bet you that's going to be discounted, because nobody would believe that that would be the same. Yeah, guys, it does take 2 years for the process to get out of the EU. I mean, there's a lot of stuff to undo. So, but anyways, on the short term, I think what the Fed talked about in the last meeting may not be what they're talking about now, maybe on their cell phones, right? So anyways, and then we got ISM services today, which is another great one, and that's going to be at 10. So we got a big day. Now, can someone confirm ADP today? It is today, right? Or did they push it off till tomorrow? I don't have the calendar right in front of me. If it's tomorrow, then so be it. Yeah, is it tomorrow? All right, thanks. All right, so that's even better. So we'll save another dumb prediction for tomorrow. So that means, really everything is, the real news then is going to be 10 o'clock, then 10:30, and then 2 o'clock. So well past us. So what that means for the market is it's going to trade technical, and then fizzle out, and then trade fundamental. So did anyone post a trade plan today? Think about their trade before actually pulling the trigger. Just imagine you documented your logic in a fair amount of detail before pulling the trigger on a trade. Yeah, Ambassador, of course. Pound, pound dollar and pound yen have been incredible. Well, of course, right? Right? So just imagine, though, you're trading, guys. Just imagine you're trading. If you documented the logic before you made any trade, took multiple time frame screenshots, uploaded things and identified your levels of support and resistance and maybe 2 or 3 reasons why you're a bull or a bear, and you documented all this before pulling the trigger. Imagine you took 20 minutes to write it all down before you made a trade. I bet you would trade less. More importantly, you'd stay out of stupid trades that are not worth the documentation. So if you've ever read my book, I suggest all these different things, that you have to journal every trade you ever make. And this is an important step, not because you have a journal, but because what will happen, and this is what I found. Let's say you make 10 trades a day and you're still not quite profitable. What will happen is you end up spending like 3 hours or 4 hours a day journaling. And if you're hardcore, you do it for every trade. And over a reasonable amount of time, let's say in over a couple of weeks, right, what'll happen is it will consume your time. And you're like, holy crap, do I spend a lot of time journaling. So what'll happen is you'll start filtering your trades based on whether it's worth journaling or not. So you say, well, I kind of want to, take a shot here, but it's kind of mediocre. It's kind of hit or miss. This one's about a 50-50, and I just really don't want to spend 20 minutes journaling it. And your laziness will provide efficiency. And what'll happen is you just skip all the stupid trades. But that's what it's all about. That's why I actually talk about that in the book. That's why you do it. Not because you have a journal, but because you start to stop throwing your money away at stupid trades because you get emotional. It's a whim. You're like, oh, look at that. Oh, is that a pivot point? Boom. Let's try one there. What the hell kind of trade plan is that? Let's give that one a shot. It only takes you, 1 second to throw away $100 on your mini account, right? Yeah, good job. Some people take a whole hour to lose $100. But you took 4 hours to lose $100 on that stupid trade. Yeah, good, right? Have you ever been in a situation like that? You're like, well, yeah, this time I blew up my trade account, but it took me like 4 or 5 months, not 4 or 5 weeks. So I'm really improving. You've never thought that way? Like, oh, that was actually pretty good. Woo, 5 months. That's a long time to slowly die of 1,000. All right, okay, yeah, all right. Nobody here was like that. Okay, that's good. All right, very good. Everybody here is unique and special. So anyways, let's do some technicals. We have gold going up. How does it look? Life is great. Life is grand. Life is good. Life is beautiful. Well, it kind of looks like we're doing good so far. Did I get in the USD CAD yesterday? Well, I don't have to pip and tell every day. All right, so yeah, anyway, so it's working its way up on the higher time frame. As you know, we have this going up to, what is it? 1384. Yeah, it's only made it to 1374, so we have $10 more to go. But of course, we started this journey at about 1310. So that's $60, $65. That's not bad. Little swing trade. Peter says gold is ridiculously bought on the commitment of traders report. Okay, yeah. But there's a reason for it. What is the reason? No, not Brexit. It has nothing to do with Brexit, in my humble opinion. People are scared. No, I don't think that's true at all. Negative interest rates. Thank you. That's it. So the interesting thing about the market, this group of humans, most of the time, or let's say not even most, much of the time, they are logical. Okay, it is Newtonian. Much of the time you can use like the Black-Scholes model to price options. Okay, and then some of the time it's completely emotional. And if you think the markets are a random walk, or if you think the markets are predictable in your silly little models, you're very, very mistaken, and you can get clobbered. And all of a sudden it's pure emotion, and everyone's running for the extremes, right? Everyone's extremely out, or everybody's extremely in. So anyways, I think gold going up is a logical, intelligent reaction to negative interest rates. Because gold pays 0%. If you were to pretend it paid an interest rate. Okay? So you could put your money in gold and it pays 0. You could put your money into yen or Swiss franc or euro. It's a different asset class, but it's another place to put your money, right? Put your money in a bank in Berlin or Frankfurt, right? But there's a yield on that asset as well, right? Remember, return is a function of yield per se, and then or price and whatever. All right, whatever. Let's keep it simple. So you have two choices where you park your money: a bank in Frankfurt, but you're guaranteed to have a negative interest rate, or you could just simply park it in gold, and your interest rate is 0. Okay. Either asset class could go up or down, but this one you might say, well, based on these market conditions and price, this will go up, where euro is likely to go down, so therefore price going up on gold, and the higher yield, which just happens to be 0, makes gold much more attractive than putting it in a bank to be safe there. Because, all right, so let's say it's in euros or Swiss francs or something, right? Okay, that's cash, right? But remember, gold is cash too. Okay, I mean, okay, if you want to get into it, it's not cash. It's not part of the M1 money supply, right? But and it's not easily divisible and stuff. It's not a bar of gold worth $30,000. You're not going to take to the grocery store to buy milk and eggs, because you're not going to shave a few shavings off, right? But it is convertible fairly easily to any currency you want, right? Right? If I showed up in Gabon, Hello, come on. Oh man, I don't have any cash on me, but I have this bar of gold. I could probably get through the day. Okay. Hey, whoa, 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 whoa. Okay, so anyway, that's why you can see it's more attractive than it was before. Now, when interest rates were 0.5, that may not, it changes things. Even though it's not much, it's enough. Okay, and in particular, negative interest rates. No one likes to be guaranteed to lose money, right? Imagine you ran a portfolio of $1 billion. You wouldn't want to be guaranteed to lose money. Miles wants me to go through the Black-Scholes option pricing model. No, I won't do that, but I'll get you a video and I'll post it on YouTube if you want. But what's the most important part of the Black-Scholes model? Anybody know? Is it relevant? An options pricing model, is it relevant to spot Forex? Well, what do you think? Does pricing options impact the foreign exchange market, spot price? No, yeah. But in its volatility. Okay. So if you're, let's say, okay, let me give you, you brought it up. I'll just say something about it. Normally what a true, let's say, hedge fund, that's sort of hedging, will buy one asset and sell a similar or exact asset at the same time, either in the same market or in diverse markets. Okay? Okay, besides hedging, what else could you call that? Where you buy one, arbitrage. Okay. So if you're interested in the Black-Scholes pricing model, one of the strategies you might be employing is truly an arbitrage situation. And what you're looking at is, let's say, the spread between two similar assets. Let's call them bonds. Okay? The spread between these two historically is going to be at a norm. And the most common play here is when you notice, let's say, the spread on the 10-year bond and the 10-year, or the 30-year bond and the 30-year bond in the United States. It's way out here today, but it's usually down here. Okay, and that spread is going to be created by volatility. So like the VIX, let's say you could look at the VIX if you're looking at volatility in the S&P 500. Well, if it's almost always sort of in this range, but for some reason it's this way out here, then something unusual is happening. Okay? So price or yield is way off and there's something going on and everyone is greedy or everybody's scared. Okay? And generally what we're talking about is everybody's scared and the spread on these things are going to widen, right? And so what you would do is you would price everything out, and if you get the volatility right and all that kind of stuff, you buy the one you think will go up and you sell the high one, which should come down. And as long as one goes up or one goes down, or ideally they both come in, then it does narrow and you make money. Meanwhile, you own this one and you own this one and you're selling this one, right? So that you should be hedged if they're essentially the same asset, right? Or similar to it, right? Like another spread play would be Chicago wheat versus Kansas City wheat. Okay. Another way of doing it is oil and gasoline. Another way of doing it is soybeans and soybean meal. So Miles, the idea, if you're hedged, okay, right? So there's two ways of making money. Like, how about let's take Forex. What if you could almost completely remove the your exposure to the foreign exchange market? So let's say you're long one pair and short the other pair. And so let's say you're long pound on one thing and short pound on another, and you know, therefore you're nearly perfectly hedged. You have two other currencies that you're exposed to. And then, but the upside is you will make interest. So you're long one, you're short the other. So let me just make something up. I'm not even going to pick a currency pair because it's not good in these conditions when nothing pays any yield. But let's say, you know, you're making 8% on a Kiwi, but you're short, let's say dollar when it was 5%. But almost all of your exposure has been hedged out through being long and short against the pound, for example. So at the end of the day, you probably don't face much foreign exchange risk because you hedged out as much of it as possible. And the cost of it is, you know, 5% on one, but the income on the other is 8%. And so you face almost no risk, but you'll clear 3% on the interest. Well, that's one example. You can make it as complicated as you want, okay? But a Black-Scholes model would be figuring these things out, whether the price is right on one and price is right on the other. So it depends on the scenario in this case, and then it's for options. If you get the volatility wrong, however, you're going to lose money. So the way you lose money is you plug in your volatility in your Black-Scholes model for your options, and you're like, okay, this is a good price as long as the spread narrows. But what if the spread doesn't narrow? Okay. So like, let's say you buy the 10-year T-note and you sell junk bonds. And you're like, wow, everyone's getting out of junk bonds. That's because, you know, these the oil industry is crashing because of low oil prices. So what's the play, right? You're like, wow, the junk bond industry is desperate for money. So you're going to lend them out. You're going to get a high yield. You're going to pay a very, very low price. Probably get a huge discount buying junk bonds, right? And then what if the spread doesn't narrow? Some of the junk bond issues start to default, and the spread widens even farther, and you end up losing money. So whatever, we don't need to talk about Black-Scholes. I'll post a video. You know, there are a couple of components to Black-Scholes. One's fairly easy to explain in the formula. The other one's a lot more complicated, but it usually comes down to volatility. You get volatility right, you make money. You get volatility wrong, you lose everything. Okay. Yeah, the Russian default. All right. The thing is, the Russian default was preceded by the Asian flu or whatever they called it. and the Asian tigers. There was a lot going on in the world that led to the Chinese default or the Russian default. And if you're talking specifically about long-term capital management, that giant hedge fund that blew up, if they had stuck to the stuff that made them their PhDs and then later on their Nobel prizes, if they stayed to the model that they put in their disclosure documents, and in the first, I think, 4 years, they were just fabulously profitable with very, very low volatility in a portfolio, which is something that you look at risk-adjusted performance, and their numbers were awesome. It was just ridiculously amazing, and that's what they said it would be, and that's what made them famous, and that's why they won Nobel prizes. They were smarter than everybody, and then they got stupid like everybody else. I mean, they literally blew themselves up. They were dumb, absolutely stupid, dumb. They changed everything. They got greedy. They got as stupid can get. I don't care how many PhDs you have. Oh, you won the Nobel Prize? What an idiot, right? Like they really were stupid. The stupidest Nobel Prize winning people that you've ever met. Because they were smart and then they got stupid and they blew themselves up. That's stupid, right? No, not really even with the same model. They started changing things and they started betting on things and these idiots used, like, by the way, Scholes was part of long-term capital management. They use so much leverage. They're, almost as much as you, right? The message is lower your leverage, guys. They use so much leverage that, and on top of stupid bets, that as soon as things turned, well, let's put it this way. They lost $3 billion in 5 weeks. And these were the smartest people in the world. Excuse me. 5 billion. Was it 5? 3 billion. 3 billion in 5 weeks. Yeah, so anyways. It's because they were stupid, not because they were smart. They raised money because they were smart, and then they lost it like everybody else doing stupid things. All right, so anyways, moving on, .com. Again, we talked about the rig count on Friday and even Thursday and Wednesday of last week. We got this topped out at 50. I think we were up here, 48 yesterday. We still have it coming down. Can it really go down to 40? I'm not actually predicting that. I think we're in the big sideways, right? Wow, I'm losing my voice again. Hang on. Me. So anyways, down or sideways is really what I'm thinking. No reason for it to go up, no real reason for it to go down. Okay. But at least if you're trading it on the small time, hey, selling it at 50 makes sense, doesn't it? So here we are down at, on our way down to 45. You can see there is some sort of support coming up soon. I wouldn't make a big deal of it. So this afternoon, or not this afternoon, later this morning, in about 2 hours and 15 minutes, we'll get oil inventories. And that should help move this, and that should impact the kitty cat. Did you see USD yen? Beauty, huh? So was it yesterday we talked about it in here? 101, and then the next one is this 150 area. So, we're getting close. It's getting interesting. The higher one had the monthly, right? The next monthly is like 98. And I think 98 was sort of the intervention area. You know what I mean? Yeah, I'm pretty close to the target though on gold, so there may only be one more day left. Do I expect a reversal? Well, let's go back to yesterday's language. Between 98 and 95, I would be on red alert for intervention from the Bank of Japan. How do you trade that? You buy it at support after a reversal pattern on a small time frame and move your stop close. And be long when they weaken the yen. But there's no real way to trade it. But if you're a bull, you need to buy at support when it issues reversal patterns. Okay. And one of the things, you know me, I'm a lover. Right. There's no anger in my heart. But the thing I hate most in trading. Will they announce it? No. It'll just be, holy crap. It'll look like Brexit. You're like, what the hell was that? Oh, that was Brexit. So anyways, the one thing I hate in markets and trading and seeing traders do is buying crashes. So don't buy because you think there might be intervention. If this is falling, you should be selling it. But in this particular case too, if you're worried about intervention in that case, then you need to make sure your stop is there. But you could also, if they did intervene, and I wouldn't assume they intervene at 100. That doesn't seem like good enough to me. But if they do intervene, it will be up at least 200 pips instantly. And your stop will be worthless. So if your stop was 25 pips away, now you're 225 pips in the hole. Okay. So what I would wish for you in your trading career is that you're selling in bearish markets and in particular falling markets, and you're buying in rising markets. I know it sounds logical, doesn't it? Yet almost nobody does it. So that's what I wish for you. My wish for you is that you're selling in falling markets and you're buying in rising markets. And you're not buying high or selling low, right? You're buying dips and selling rallies. Peter says he read that the profitability of Japanese exporters lies between 100 and 105. So that number changes all the time, Peter. And by the way, it's a pretty general and broad statement to make for every manufacturer in Japan. So what does that number come from? No, but see that number moves. So if you're a CEO, you sit down with your chief financial officer and their team, and you have a foreign exchange expert on your team somewhere because you're an exporter. And you guys decide what the USD yen is going to be at on average for a period of time. Remember, everything has a period of time. So how about like over the next 6 months or over the next quarter, right? They say, all right, well, over the next quarter, the USD yen will be, on average 105, or from 100 to 105, as you report about a report you read somewhere. Some guy told me on the elevator, right? My shoe shine boy told me. Yeah, all right, good. Um, oh, we have movement on the euro. Movement on the euro. Oh, okay, so going back to this, so they say somewhere between 100 and 105. So what they do is they hedge. That's all. That number could be 105 to 110. It could be, it used to be 115. I remember the day it broke 115 and we all cheered and it dropped 400 pips because it was so significant. Now it's not even significant, right? So, that number is always there. Okay? So just be careful when you read in all these newspapers and stuff. Most of the time they have no idea what they're talking about. Yeah, they honestly don't know what they're talking about. And maybe they do. They talk to somebody, and in some company somewhere, and he says, "Well, the manufacturing industry has the profitability set at between 100 and 105." Yeah, that's probably true. That also goes without saying. And not one CFO wouldn't know for the whole industry, but you could guess. What's the value of the USD yen these days? Oh, somewhere between 100 and 105. I mean, you can see by looking at your charts, and they're hedging because that's their job. They have to lock in today's price for the future so that they can plan their budgets appropriately over the short while. And then in 3 months, that number will change, right? I mean, it's funny, but all this information comes through our wires, right? From all these different sources. And, so much of it doesn't matter. But it sounds important, right? Like, oh my God, if USDN goes down to 98, manufacturers in Japan will not be profitable. Well, that doesn't make sense because they shorted the market at 103. They're hedged. That's why they did it. But thank you anyways, Bloomberg. That was really good. Yeah, so, don't worry about it. Don't worry about it. Forget about it. All right, so what's going on with that Euro dog, huh? Mortgage applications way up July 1st. Whoop, whoop, whoop. It's because people buy houses in June and July, so don't be shocked. Did anyone trade the zloty today? No? All right, you're lost. Let me look around the world here. Copper breaking through a monthly pivot. Cash oil back above 40. It's at 46 right now. What else going on? Dixie found weekly central support. And the 1 hour Dixie oscillator wants to rise, so maybe some dollar strength, but euro is going up again. I suppose it could, hey, Miles? I mean, you know, I'm looking at Euro USD, and I mean, if you're a bear, you're setting it up right now, and you're probably eyeballing, 110.80 to 111. But that's nothing new, right? If you're trading the daily, you already shorted it off the 21 yesterday, so now you're doing a fib retracement of yesterday's range. But all that's really basic, right? Life is beautiful. Yens. You shorted the hourly 21, you got knocked out? Well, perhaps your stop's too close. Boom, boom, boom. Boom, boom, boom. Yeah, well, like I said, lower your leverage. Right off the bat, cut your lot size in half and see how you do. Right? Cut your lot size in half, double your stop. Double the powder, shorten the fuse. Life is beautiful. So, remember that I missed that opportunity at 70. I was looking left. We're back down to 71 and a half. What do you want to do with this? I need to make some decisions, and I'm not quite there yet, but I guess we're getting fairly close about buying and holding. It's usually a little too early to start buying, but you never know. I mean, that's what makes trading difficult. Oh, tonight's Mega Million is $508 million. Can you imagine if you want like 500 million US dollars and you move to like Portugal? Or Gabon? Is that right, Andrew? Yeah, it's probably still too early, but thinking about all, going back so many years, it seems to me, and again, don't quote me. I ain't saying. So, anyways, it seems to me that July I do spend time building a position, and then I lose it. And maybe that's the right thing to do, but it just feels that way. It could totally happen where you just build your position and then you can lose it, and maybe that's just part of the job. No, you don't hold positions, but eventually I'm going to want to build positions, which is sort of different, right? So that's what I'm talking about. This is probably too early. You got to skip scalping and stuff. But you never stop eyeballing the market, though, right? Like when is the right time to transition from scalping to building positions this year? Is it today? Is it next week, 2 weeks from now, 4 weeks from now, 5 weeks from now? Okay? Because there's seasonality, Peter. So you're buying too high or even buying too low maybe. But for example, what if I start tiptoeing in some trades on like Kiwi and Aussie, and it's a dangerous thing because they're not really bullish. So if I had binaries, I could hedge that way, or I can just keep my stops reasonably close, keep my lot size reasonably small, and if it turns profitable, move my stop to -1 and just be okay with that. And then, so let's say I tiptoe into 10 trades this week or over the next 2 weeks, and then 3 weeks from now, the Bank of Japan intervenes. Okay? You see what I mean? If I'm in 10 trades, I'm up 3,000 pips in a day. Yeah, but see, Miles says too easy to get knocked out of that. Well, and so a compromise that I can do here is I can scalp short and hold long with stops at break even. Yeah, I got it. It's trade balance. It's not that big of a deal. It's 1.1 bill, just fine. The spread, I mean, 41.1 bill over 40 expected. That's fine. I mean, so anyways, does that make sense? So I could be short-term short, but long-term long, and say I'm happy to pick up 25 to 50 pips on the way down, and I never cash out on the way up. I mean, so and if that's a strategy, do I do that now in July? Usually not. Um, but in August, yeah, for sure. By August, eh? Well, so John, so like there's all these different questions we need to answer. Are negative interest rates going to get negativer, more negativer? Are they going to increase the negative interest rates, which is lower? Um, right. So our negative interest rates going to be more negative? Um, you know, is, is the global market going to crash more? Well, if you look at what's happening with pound, it actually doesn't feel like it crashed to me. Does it feel like it crashed to you? See, to me, it feels like the market's just adjusting. They're like, all right, you want out of the EU? All right, well, we have to discount for that. Oh, your central bank's gonna, devalue the currency a little bit? Oh, okay, well, that's fine, right? No, but it's just like, look, we're at 29.59 right now, 129.59 on pound dollar. If Carney, during his stability report or whatever it's called yesterday, if Carney had a different discussion yesterday, would we be at 129.59 or we'd be at 133? I think we'd be at 133. That's it, right? So it's just like Carney did this, right? That's it. Carney did this by design. And in fact, he told us he would do that last week. Okay? So this isn't a crash. It wouldn't have changed value. Carney changed the value. So the market needed to adjust. That's all. Like, oh. Right? It's like when Governor Stevens said, oh, no. The Aussie USD is not worth 90, it's worth 80. Boom. We dropped to 80. And he says, no, it's not 80, it's worth 70. Boom, we dropped to 70. That's it. I mean, it's not the market. It's not a crash. It's not the end of the world. It's not the end of capitalism as we know it. Well, no, it was just that's what's supposed to happen. You want companies to be able to borrow money. That's it. No, it's not to help the footsie. It's to make sure the system functions. That's all. There's no major policy shift or anything yet. And there's no craziness to it. There is an perceived, at least, increased risk in the UK economy from this massive change. So he's just making sure the market or industry or economy, what as broad as you could possibly say, the economy is ready and stable to be able to handle that transitionary period, right? So it's just an unknown. It's a risk. Should Carney raise interest rates a full percentage point? Should the government come in and raise taxes by 5%? Would that help during this unknown period of transition away from a major trading partner and relationship? And the answer to all of that would be no, that would not help. That would be, adding strain to the system that already is feeling some strain. So it's simply, well, the government's not going to do anything because they're stupid. So therefore, Carney's just making sure that capital is available, credit is available, the banks can withstand a shock if there is one, and that's just your normal regulatory and monetary policy process, right? Wow, is Messi going to jail? Oh my God. Whoops. That's where you just want to run, huh? Mr. Messi, would you please stand up for your sentencing? Mr. Messi? Messi? He's gone. He bolted, sir, about 2 minutes ago. Yeah. Yeah. Well, Hillary Clinton was grossly negligent in her handling of national security matters, which is a criminal offense, but not for her. Just like, oh, well, she was Secretary of State. She grossly mismanaged national security matters, but when you're Secretary of State, I mean, I guess it's not a problem. Yeah, amazing. You're like, really? Because it's even worse when you're Secretary of State. Doesn't it make it 10 times worse? But anyways, all right. So Kiwi yen. So yeah, so maybe start thinking about maybe doing something sometime soon. So I like to watch big round numbers, daily S2, double bottoms. Kind of like those, don't you? One bottom's good, two bottoms better. There's your double bottom. Double bottom of a double bottom. So, do you start playing these? And so I'm not going to give you an answer because it's up to you to decide, right? But at some point, do you play these long and just say, all right, well, I'm gonna put my stop here. Let it go up. It's going to come into this resistance area, so you're going to get 72.50, probably for sure. Got to get through 72. And then if so, it'll probably come back down to 72, in which I'll probably add another one, and then move this one to that stop. And then if this 72 holds, it's probably going to go to 73 and break this. And therefore, now, I leave this stop, because it'll be up here by then, and I'll leave it at 71.80 forever. And there's a more than reasonable possibility it comes down even farther and knocks me out. And I'll say, zittele. Right? It's July. What are you going to do? Gave it a shot. There was a possibility there. But what's the other choice? Not doing anything. And then the Bank of Japan intervenes and you're like, oh man, I could have been long 3,000 pips if I had only played it. What's going to rock your world on December 31st when you look back at your trading year? July, when you picked up, those 3 or 4 extra trades at 25 to 50 pips each? Or the time the Bank of Japan intervened and you made 3,000 pips in a day? Which one's going to be the one you remember? Okay. Okay, we're not far from a pivot on this euro dollar. We're getting pretty close to 111, so I'd be on shields up red alert notice. Okay. So anyways, you should probably print this chart out, analyze your Kiwi yen 15-minute chart and hourly chart and 4-hour chart and daily chart, right? Weekly if you want, I don't care. And decide where you think we could be at the end of the year. Fred, if you were to just boil my trading down, my personal likes, how would I describe myself as a trader? Dollar or yen. Okay. Now that's oversimplified, but that's all I need. That's all I want. Okay. Yep. That's all you need. Oh, sorry about this. So, so think about it, guys. Really, make it an assignment. Look at it. Think about where things could be. And if not today, when? If you think this is going to go up, is it this week or next week or the end of the month? When do you start chipping away at it? How would you like to handle it? What do you think could be an interesting strategy to expose yourself to the upside, but while at the same time protecting yourself from the downside? Right? Just get yourself out of the sit down and trade mode. I'm telling you, you're holding yourself back from greatness. Okay? You'll always have the opportunity to sit down and trade. Okay? Move yourself above it all and really look at it from the outside. Not the inside out, right? But from the outside in. And just, manage the next 6 months. This is a really interesting opportunity for you because we're in the second half of the year now. Manage this completely different than you ever have before. Warren says, could Kiwi yen drop to 69? Sure. And then what? What will you do? How will you handle it? And if you see that as a likely possibility, do you ignore things like this double bottom on a 15-minute chart? And you're like, well, it can come down to 69. So you're just going to throw away that double bottom. But I see things like this, and I like, I don't know, my hands start shaking like, oh my God, I need that. I need that so bad. Oh my God, is that a double bottom? On a daily S2? Oh my God, I need that so bad. It's not, daily S1 would be nice. Daily S2? holy smokes. Oh my gosh. Like, holy crap. Right? Yeah, Martin says a monthly S2, like, I mean, it just goes on and on and on, right? So, all right, so you're going to throw that one back because that fish is too small. Okay, fine. There's your strategy. But what if that is the bottom? It could be, right? You see what I mean? Who said about the 69 that it could go down to 69? Well, where did that? Oh yeah. All right. So Warren says it could go right. Okay. Good. Good. But what if it doesn't? Okay. So now this is why you need to make these decisions. What if it's What if it's 71? What if it's 70? What if it's 69? Okay. So, well, it could be 71 with a setup like that. So maybe you take the shot, move your stop to break even. You know, I mean, you could easily have done that by now, right? And you're just like, that's that. It could go down to 69, and I'll try the same thing at 69. I'll trade the double bottom at 71, at 70, at 69, at 68, at 65, 62. As long as I got the double bottoms, and I know it's a risky trade. Why is it a risky trade? Well, no, actually, I shouldn't say risky. They're all risky. Aggressive. Why is it an aggressive trade? Because you're picking a bottom, right? And that strategy always stinks. You're buying in a falling market. Okay, that's fine. So that just means, you know, you're going to move your stop a little quickly, right? So let's say when you took the shot down here at, you know, let's say 71.30, 71.40, 71.50. Okay, your stop's down here at 71. So you're using a 50 pip stop. Okay, and then once it makes a higher high, you move your stop to break even. I like to move it to -1. That's fine. So I move it to -1. And you say, well, that is the strategy. Okay? And you're like, that is the strategy. And what is the target? There is no target. The goal, hold it till December 31st. What if it goes down? Well, whatever. Who cares? Well, why would that matter? Okay? Well, you're like, what? You just ignore it. The goal is to hold it to December 31st. Wouldn't that be amazing if this thing turned around by then? It doesn't feel risk on now, but it feels like the blood in the street could be, I don't know, drying up. I don't know, right? I mean, just, I don't know. So that's the thing. I just don't know. And if it goes farther down, what does that matter? Like, right? Why does it matter if it goes down? Well, what if it goes to 71? What if it goes down to 70 and a half? What if it goes to 69? Well, if I see a double bottom, I'll buy it. Like, so what? Right? So that's the thing. When do you get in the game? When do you start doing that? And so, you know, if you want to be a professional trader, you should start asking yourself these questions. You should treat the next 6 months completely different. Stop thinking like an amateur, right? How many stop losses should we tolerate? I don't understand that statement. What do you mean? There's one per trade, right? Well, so that's one of the messages. How many times should you keep trying, right? This is one of the messages that I try to get across. And I've said it before, so I guess this is a good time to say it again, especially if I'm wrapping up. Allow yourself, and so sometimes you really need to come, it's an emotional and mental place. Maybe you need to write it down and say, this is my plan. Therefore, it's written down and it's available to you emotionally and spiritually and all this kind of stuff. That this time of year, you're not even trying to make money. Okay? No, you're not losing money, but you just assume in July it's not going to be a great month, and in fact it could be a poor month. So that means you could ignore it and go on vacation, or this could be a strategy month. So that's why I'm asking you to think about these things. What's August going to be like in September? And what are you going to do with your trades now that gives you bigger opportunities later? And so, Miles, if you made 27 long trades in the month of July, and let's say half of August, they're all long yen pairs, and all 27 of them broke even. You should feel good about that. And you should tell yourself that now. You gave yourself 27 opportunities to hit home runs. That's all. As long as you don't lose money. Now, losing money is never a good strategy. And did I say, like, buy Kiwi yen and now you're down 150 pips, and then you buy it again at 70, and then it drops to 69, so that one's down 100 pips and the other one's down 250 pips? No. Should you martingale the sucker and double down on the second one? No. Should you grid the thing, keep buying as it's falling? No, 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 no. I didn't say any of that. Okay? But if you're a bull, buying double bottoms and holding long and breaking even is an acceptable scenario, if you allow yourself that. Now, a lot of people will get frustrated. Man, that's like the 7th trade. I was up 35 pips on that and came back down and broke even and blah, 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 blah. And some people just get so upset and emotional and their stomach churns and they get mad and they're like, damn. And it doesn't do any good. So you should say, oh, got that as a double bottom, got my stop in, cool. And if that goes profitable, I'm going to sneak my stop at break even, cool. Got another one. That's that. And then on the way down, you're like, oh, look at it flip. Take the shot. Now you're hedged. But you don't hedge long term, right? So maybe then it falls for an hour or two. You pick up 25, 30, 40 pips. Boom, nice. And then maybe it bounces here at 70, 92. Right? So maybe this is the first time in your trading history that you're playing both ways. You're long off the double bottom and you're selling off the resistance. And you say, this could go to 69. Or at least back down to 71. You're going to pick up 70 pips. Maybe 100. So, but the thing is, if you sell, you intend to take profit. If you buy, you intend to remove risk. You're short-term short, but long-term long. And this actually hedges your long, right? So if you like that idea, it may be early in the season for that strategy, right? But I don't know when, it's not like hunting season, right? So, you should just relax, accept it. Just say, this is great. This is really cool. Now I can change my trading strategy to for the change in market conditions. So you're scalping short, you're swinging long, and you know you're not going to make much money. You're not even trying to make much money. You're just going to chip away, right? Shawshank Redemption, just chip away at the wall. In 15 or 20 years, you'll break through. Just chip, 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 right? And just relax, man. Enjoy it. I read a book about, it was written by an Aikido master. Now, Aikido uses energy. Okay? If you're in a street fight with an Aikido master, he'll hit you once. It won't even be hard. He won't break your nose, but you'll be on your back really quickly. And you might have a broken thumb. But the interesting part of the book I found is he says you should enjoy the plateaus. Where he says a lot of people, they take a martial art because they want to get a black belt. And they want to get the black belt as fast as possible. And I want to progress. I want to progress. I want to progress. I want to progress. What's the new thing? Right? Give me the new kata. Right? And just with the mental and spiritual attitude of that, you will never master your art. You'll never be a master. And there are these normal ebbs and flows where you learn something new and you practice, right? And you're mastering that. And now you're slowly forgetting the other things that you had just learned in the previous round. Okay? And so you have these peaks and valleys of growth and, you know, in our case, profitable months, sort of not very profitable, you know, moderate, big, moderate, loser, you know. But he says if you come in with a whole different mindset of just enjoying being in the room, enjoying being on the mat, the smell of the air, right? You enjoy just standing in front of the mirrors. And you're enjoying that moment, even if you're just repeating the same thing you've done week after week after week, same thing over and over and over again. But you're enjoying the process and even the plateau where you're not rapidly progressing. You're not like, give me the new thing, give me the new thing. I got to get my green belt, and then after the green belt, I got to get, and then whenever, and then I got to get a black belt as soon as possible. I need a black belt as soon as possible. Right? You're holding yourself back of truly mastering your art. And it's very, very similar to what we do. If you know July is going to be a moderate month, and that we could lose volume and volatility in the next 5 or 6 weeks, you should enjoy the process of transitioning to that market and being in that market. And more importantly, you should change your behavior and expectations for these changes in market conditions. Enjoy the, you know, maybe you're doing 25 OCOs on the downside and you're doing 5,300 on the upside, and you're just kind of enjoying the observation of this process. And maybe over the next 3 or 4 weeks, you break even a lot. And you're like, this is cool. You know, I almost had it, you know, and you just enjoy the plateau. Okay? Just enjoy being a currency trader. Just enjoy to say, wow, July is always like this. This is cool. You're like, I'm glad I know this ahead of time. I'm glad Wayne told me about this in February and March and April. Now here we are, and cool, let's change things up. Let's adjust. Let's see how this goes. See what I can learn. And I think you'll be in a much better place mentally and emotionally and spiritually and so on and so forth. To say to yourself, I really enjoy mastering foreign exchange trading. It's really great. I can now sense the change in market conditions by market participants, and that I can't wait to see how between now and September things change once again. And it'll be great if I can every single day be aware of my surroundings and sense the sentiment and be ready for that transition into the next wave of trading to the end of the year. I wonder if I can spot this. Is it today with this double bottom? Is it 2 weeks from now? 4, 5 weeks? Is it the third week in August? Like, when is it actually going to click? And am I going to be able to spot this as a currency trader? And can I be in trades when the market comes back? Right? Then you'll enjoy this period where most amateur traders get frustrated. Okay? So I hope you can give yourself that opportunity to enjoy the plateau of the next 6 weeks. And by the way, if things work out well, and it doesn't always, the next 6 weeks you won't make any money, but it will set you up to make more money, or let's say pips. Let's talk about pips. More pips than you ever dreamed of. Okay? If you've never made 1,000 pips in a month, I will help you make your first 1,000 pip month. Okay? I will predict that it will be September, and it will be because of all the work you do in August. So by definition, August is not going to be a good month. But September will be the first month you make your 1,000 pips. Okay? Does that sound like a fair goal to look forward to? Now, do you think you can do it without intent? Do you think you could just walk in and walk into the 1,000 pips? You have to have intent, which means now you need strategy and execution and control to pull it off purposefully and without risk. And that starts now. So when I say you look at your charts on multiple time frames and try to look at it from the point of view of where we're going to be by the end of the year, maybe you need to do stuff like that. But sit down and say, and really, maybe even say it out loud. Tell somebody, I'm really enjoying my time in Wayne's webinars. I really am starting to enjoy being a currency trader. And this is great because market conditions have changed pretty quickly, maybe have changed completely since Brexit. And now we're going to move into a summer period where things could change. We could lose volume and volatility, and therefore I'm going to look at it a little bit differently. And meanwhile, I always got to look at things on the bigger term as well. And I can't wait to see what I'm going to do over the next 6 to 8 weeks to make this profound September, or maybe it's October month. And it's going to be this wonderful grand experiment. Like, how cool is that? Okay? It's sort of like sitting down to write poetry. You're not entirely sure how it's going to turn out. But if you enjoy the process and allow it to happen, sometimes you can surprise yourself. Peace on earth, may the pips be with you, may your profits be above average. Remember, 9:30 stock market open, 10 o'clock ISM services, 10:30 oil inventories, 2 o'clock Fed meeting minutes. Another beautiful day to be a foreign exchange trader. I hope to see you again tomorrow. Thank you for all your sharing and carrying on Forex.Today. That's really cool, guys. Cheers.